Okay, so this video is going to be looking at the 2024 company final accounts Yeats Ltd. So again, we're just going to look at all the different steps that we're going to take in which to complete our final accounts. So step 1, lay out our accounts, which would take us 5 or 6 minutes. Step 2 is transfer our figures into the accounts from the trial balance, which is 6 or 7 minutes. Step 3, calculate the investment income and debenture interest for the year, which will take us 3 or 4 minutes. Step 4, complete your adjustments, approximately 32 minutes. And then last but not least, step 5, top up your totals, 5 minutes. So you have 54 minutes in total in which to do it all. But you might find if you do it this way that it will actually save you a lot of time. So this is just an example of a company account from 2015. There's no lines drawn down the page. Whatever you have to do all your workings on the face of the accounts, and it'll save you so much time. Okay, so looking at steps 1, 2 and 3 first. Step 1, lay out your accounts. So you can pause the video and copy the layout now. Step 2 then, transfer your figures into your accounts from the trial balance, and this will take about 6 or 7 minutes. So we're looking at the trial balance only from the question, and we'll forget about everything else for now. So you'll see here that your assets and expenses are on the debit side and your liabilities and revenues are on your credit side. So going down through the trial balance, we'll just identify where things are going to go and then we'll slot them in. So land and buildings at cost are going to go into the tangible fixed assets, as will the accumulated depreciation. The authorised capital up above at the top of the question, that's going to go into the balance sheet financed by capital and reserves. The delivery vans then, that'll go into the balance sheet, tangible fixed assets. Discount net. Now the discount is on the debit side, so it's important to note that what side it's on, because discount on this side is discount allowed, which is an expense, and if it was on this side, this would be discount received. Okay, so it is discount allowed, it's an expense here. Now the profit and loss balance, when the profit is on the credit side, means it's a liability, and profit is a liability to the owner, so that means that the business did make a profit that year. If it was on this side, it would be a loss, so they have made a profit this year. Okay, so that's going to go into, so the discount allowed, S&D expenses in the TPL. Profit and loss balance will go at the bottom of the trading profit and loss. The stock, opening stock, will go in the trading account. Debenture interest for the first 9 months. So you have debentures for the whole year. You've only paid 9 months. That means there's some debenture interest due at the end of the year, which will go into creditors minus 1 year. You will always have debenture interest due in a question 1 final account in an honours. Okay, you'll always have investment income due, you'll always have debenture or mortgage interest due. Okay, 3% investments then, that's going to go into the financial fixed assets in the balance sheet. The patents, that's going to go into the intangible fixed assets. Okay, now there's 3 months investment income shoved in there for absolutely no reason other than the bookkeeper made a silly mistake. Okay, but we need to know that we have received some investment income here. So what will the investment income due be? Okay, so we only received 3 months, but we have investments for a bit longer than 3 months, so we're going to have some investment income due. And just so you know, as I said already, you're always going to have some investment income due. Purchase and sales will go in the trading account. Dividends paid will go at the bottom of the TPL. Bad debts provision will be taken away from the debtors. So this bad debts provision is, we think that of the debtors that we have here, okay, so those debtors are going to go into balance sheet current assets, but we think that we might not get 3,200 of that. So every business is just being prudent, that means being wise, by thinking some of their debtors might not pay them, maybe they'll go bankrupt, whatever it might be, but it's only a provision. Okay, it has not actually happened. They are not bad debts written off. It hasn't happened yet. And then you've got creditors. The creditors will go into creditors minus 1 year. The bank is on the credit side. That is a liability, bank overdraft, creditors minus 1 year. Salaries and general expenses will go into TPL admin. 8% debentures will go into balance sheet financed by creditors plus 1 year. Issued share capital, the same, balance sheet financed by capital and reserves, the same as the 4% preference shares. The VAT is on the credit side, so that means that is a liability, so that will go into creditors plus 1 year. Advertising is going to go into S&D expenses. Rent received, it's on the credit side. So if it just said rent and it didn't say the word received here, you need to know that that would be rent received because it is on the revenue side here. Okay, but they were very nice here by giving you the rent received, the word. And then capital reserve goes into balance sheet financed by capital and reserves. So if we were putting the figures into the face of the accounts, this is what it's going to look like. Okay, so when you're doing this, you want to make sure that you know the layout. So you've got the bones of the layout done, and then you're slotting in all of your figures. Okay, what you want to do then, when you have all of these in, okay, into the right places, you need to go back to your trading or to your trial balance, and you need to check that you have put in the right figures, because people can lose 4 marks here by messing up the figures, like just writing them in wrong. They could lose 4 marks just for one figure. So it's just so many marks for this point here. So you just have to go back, you just have to check that number 1, you've put all of them in, and number 2, that you've put them all in correctly. And when you're checking them again, you can say, oh yeah, did I put them in the right place? Like if you put advertising into administration expenses, you would be incorrect, because advertising has got to do with selling. Okay, if you put rent received into admin, you'd be wrong. So it's at this point that we can check that we've done the right thing as well. So that is step 2 done. Step 3 then, we're going to calculate the investment income and debenture interest for the year, and this will just take us 3 or 4 minutes. This is setting up a good habit for the rest of our section 2 questions, and it's also kind of getting ahead of ourselves with regards to banking some marks early in the exam. So what's the crack with investments? Well, the asset investment goes into our financial fixed asset. The investment income for the year will go into the TPL. So it doesn't matter if we haven't received it or not. If it's due for the current year, it needs to go into the TPL. Now, every single question 1 question has always had investment income due at the end of the year. Okay, so investment income due is goes into the current assets. All right, investment income due. So any investment income that we have not received yet goes in there. Now, debentures. So debentures are our long-term loan with a fixed interest on them. Okay, the debentures themselves go into the finance by section, so they are debt capital, and go into creditors' amounts falling due after more than 1 year. Now, the debenture interest for the full year will go into the TPL, okay? And even if we haven't paid it all, we have to put it in, because if it relates to the current year, we're going to put it into the TPL. Now, as I said, you're always going to have debenture interest due, so that is going to go into your creditors' amounts falling due within 1 year. So any debenture interest for the year that we have not yet paid is a liability at the end of the year. We will owe it to our debenture provider within the next year. Therefore, it will go into creditors' amounts falling due within 1 year. So that's the crack with step 3. So what we're going to do, we're going to look at our trial balance again, and this is the first time that we're taking up our calculator and using it. Okay, step 3, first time we're using our calculator, and we're going to have between 40 and 50 marks banked out of our 120 by the time we complete this step. So we're looking at the investment income first. We've got 120,000 multiplied by 3% multiplied by 8 over 12, and that gives us 2,400 investment income. That's for the year, but we mightn't have paid all that, but that's for the current year. Next, we've got 8% debentures, including 40,000 issued on the 1st of the 10th, 2023. That's 140,000. So we got a top up of 40,000 after the 9th month. So for the 10th, 11th and 12th month, we had 140. So for 3 months we had 140, but that means that for 9 months we had 100,000. So this is where most students mess up, okay, on the month. So we have to be very, very careful like the 1st of the 5th here, right? Some people, will just work with 7. 7 plus 5 is 12. But it's the 1st of the 5th, 1st of May. So we had it for 8 months. So it's very important that you calculate these right. So we've got 2,400 investment income for the year, which needs to go into the TPL. And we've got 8,800 debenture interest for the year that needs to go into the TPL. So they can go straight in here, and it's absolutely fine for you to do your workings here. Okay, you're going to be getting marks for these words. A lot of the years in the marking scheme, you don't see it in the marking scheme published online, but you're getting marks for these words here, and you're banking marks nice and early. So 2,400 investment income for the year, but we're definitely not going to have received it all. Okay, so up into our current assets, we're writing investment income due 2,400, and we'll minus whatever we will have received. The debenture interest then, 8,800. Okay, so 8,800 is the debenture interest for the year, but we will not have paid it all. So the 8,800 will go there, and then we had this 5,400 in the trial balance, and so we'll see there might be a few more adjustments that will affect that, but we'll figure it out when we get to the end of the question. But that is step 3 done. You're getting into a great habit for section 2, and you're also banking a lot of marks really quickly. Okay, so that's what your accounts are going to look like now after step 3, and at this stage you have between 40 and 50 marks out of the 150 banked, and you just have, you haven't even touched an adjustment. So it's great to get all your different steps done and just check your steps that you're right at each point. Okay, and what I should have mentioned when I was showing you the layout, but you'll see that in a separate video, is that these are very important to get right. You have to get the layout right because you will be penalised marks if you do not. So make sure that you study the layouts. Okay, step 4, we're going to start the adjustment. So you've got approximately 32 minutes to do this. So here are all the adjustments for this year. We're just going to read through them one by one and just do them as we go along. Okay, so the following information and instructions are to be taken into consideration. Number 1, stock at cost on 31st the 12th, 2023 was 56,900. This figure includes damaged stock, which cost 3,800, but which now has a net realisable value of 60% of cost. Okay, so what we have to do, we just have to do the closing stock in the trading profit and loss. 56,900 minus the 3,800 plus 60% of that 3,800, which is 2,280. Leave the brackets open because we'll have some more workings most likely. You also have to put closing stock into the current assets, and you can just write there as per TPL, because if you have the incorrect figure up here in the TPL and you write it down here, you will get your marks based on your own incorrect figure. So just write in the brackets as per TPL, and then whatever your figure is, you'll just transfer that over. Okay, adjustment number 2. The cost of delivery vans is to be written off on a straight line basis over 5 years. A full year's depreciation is charged in the year of acquisition and none in the year of disposal. Delivery vans have a scrap value of 5% of the original cost. Note, during the year, a delivery van which had cost 40,000 in 2019 was traded in for 10,000 against a new delivery van costing 56,000. The cheque for the net amount of this transaction was incorrectly treated as a purchase of trading stock, but was entered correctly in the bank account. These were the only entries in the books. Okay, so there's a lot going on here, so we just have to break it down bit by bit. We have a load of delivery vans. During the year we got rid of one and we bought a new one. There was nothing entered into the accounts. The bookkeeper didn't enter anything into the accounts apart from they entered the cheque for the net amount of the transaction as a purchase of trading stock. So they're telling you that that is incorrect, that they did that, but it was entered correctly in the bank account. So very little was done. So we have to enter everything, and we have to rewind when the bookkeeper treated it as a purchase of trading stock instead. So what on earth, how are we going to do this if we don't know the depreciation rate? So we have to find out what the depreciation rate is for this question. So it's saying here, the cost of delivery vans is to be written off on a straight line basis over 5 years. So straight line basis means the exact same percentage every single year. Okay, exact same percentage every single year. And it says the delivery vans have a scrap value of 5% of the original cost. So look, if the cost was 100%, scrap value is 5%, that means that the depreciation over 5 years is 95%. Written off 95% over 5 years, that means the depreciation rate is 19% per year. That's how you find out the depreciation rate there. Okay, so look, we'll fix purchases first. We'll fix purchases by taking away what they accidentally put in as purchases, okay? So there was an allowance of 10,000 given on the new van, which cost 56, okay? So the cheque would have been worth 46 then. So the cheque for the net amount of this transaction was incorrectly treated as purchase of trading stock, okay? But it was entered correctly in the bank account. Okay, so we need to fix the purchases. Now, if the asset van should have been debited, but it was debited into the purchases instead, to take it out, we will minus 46. So that's the purchases fixed there. Now, next thing we'll do, we'll find the cost of the delivery vans now. So you can see that they got rid of a delivery van which cost 40, and then they bought one which cost 56. So sold 40 and then add 56. So now our cost is up to 131. Now, it says then, when it comes to depreciation, okay, it says a full year's depreciation is to be charged in the year of acquisition and none in the year of disposal. So we are going to charge, right? We're not going to be charging any depreciation on the 40,000 that's been sold, but we will charge a full year on the 56. So we're going to use that 131 figure. 131 multiplied by 19% is 24,890. So 24,890 is the depreciation on delivery vans amount. Okay. Now, next we have to do the profit or loss and sale of old van. So the cost on the old van, right, we have it as 40. But how long did we have it for? Well, we got it in 2019, and this year that we're doing the books for 2023. Okay, and we have to remember that a full year's depreciation is to be charged in the year of acquisition and none in the year of disposal. Okay, so a full year's depreciation in the year of acquisition, none in the year of disposal. So we won't be doing any for 2023, but we'll be doing ones for every other year. So 2019, we've got a year, 2020 we've got a year, 2021 we've got a year, 2022 we've got a year, none in 2023. So that's a total of 4 years. So we can work out how much depreciation was charged on that old van then. So 40,000 multiplied by 19% multiplied by 4 years, 30,400. That means that the value of that van when we traded it in was 96 in our books. Okay, now we got an allowance from the Ford garage or whoever it is selling us this new van. They give us 10 grand on our old van. So that means that we made a profit in our own books of €400. So we're going to put that then into our add operating income. So add operating income is everywhere that we put revenues apart from our sales figure, of course, up the top. So profit on sale of van, €400, and that can just go in the last line. It can go this line, doesn't matter where it goes, okay, just as long as it is it's in there. Now, last thing we have to do the accumulated depreciation then of our vans. So we own 131,000 worth of vans now, and what we need to do is we need to find out, well, how much depreciation has been charged on those vans that were bought for 131. So we had 35,000 from the trial balance, right? What we do is we're taking away the 30,400 on the old van, because we get rid of the old van, we minus the cost of the old van, we minus the accumulated depreciation on the old van. And then what we do, we add the depreciation charge for the year. And that gives us altogether 29,490, and then 101,510 is our net book value of vans then at the end of the year. So there is a lot going on in that adjustment, absolutely. Okay, you just need to practice them a few times, and that is they'll be perfect then. But there is a lot going on in that adjustment. Okay, number 3. It was discovered that goods had been received from a supplier on 31st of the 12th, 2023 on a sale or return basis. These goods have been entered in the books as a credit purchase in error. The expected selling price of these goods is 5,000, which is cost plus 25. Okay, so sale or return means that you have an agreement, right, with the person who's buying the goods from you, or the person that you're selling the goods, or sorry, you're buying the goods from, that the goods must be sold, and then an invoice can be sent. So then, you can charge for the goods, okay? So you would not receive an invoice, or you would not send an invoice saying, hey, you owe me this money, until the person says, look, I've sold the goods, you can send me the invoice now and I'll pay you, okay? So this is saying goods that were received from a supplier, so a creditor sent us goods, and they said, yeah, you can have sale or return basis, so until you sell them, we're not going to charge you, right? But what our bookkeeper did was they entered them as a credit purchase in error, right? So the bookkeeper made this mistake. So we definitely did not buy these yet. We did not say, yes, we have sold them, so you can charge us for them. Okay, so we have to rewind the credit purchase. We have to rewind the credit purchase. So for us to do that, we are going to, just take it away from purchases, take it away from creditors, and then take it away from our closing stock, because we have this figure here, or not this figure, this date, 31st the 12th, 2023. Now, what is the figure though that we're going to be taking away from all of these things? Now it's saying the expected selling price is of these goods is 5,000, which is cost plus 25. So let's just work it out. So 5,000 divided by 125 multiplied by 100 is giving us 4,000. So we are taking 4,000 away from purchases and creditors, because we did not actually say that, yeah, we sold them, the bookkeeper put it in by mistake as a credit purchase, so we're going to take it away. Now the closing stock we're minusing 4,000, but we'll also be doing that then in the current assets, because it's as per the TPL. So that is that. You see sale or return, you just rewind the credit purchase or the credit sale, whatever it might be. Okay, patents incorporating 3 months investment income are being written off over a 7-year period, which commenced in 2021. Okay, so this is very important here. We're doing the books for the end of 2023. So that means they've been written off in 21 already, and it means they've been written off in 22 already. And now we're going to do 2023. But 7-year period, that means there's 5 years left. Now, we also have to look at this aspect of it. So incorporating 3 months investment income. Now, this is so silly, because why did the bookkeeper put investment income, which is a revenue, into an asset account, which is a patent? So a patent is our intangible fixed asset. So imagine your Dyson Hoover there. James Dyson has the patents on them, which means nobody else can use that technology. It is an intangible fixed asset, which means you can't touch it or see it. It's a piece of legal paper to say nobody can copy it. But that is an asset, whereas investment income is a revenue. So the bookkeeper really messed up here, because assets go on the debit side, revenues go on the credit side. So investment income should go into its own account, right? So what we do is we're going to look at the investments, right? And see here it says incorporating 3 months investment income. So we have 120,000 investments multiplied by 3%, and we'll multiply it by the 3 over 12 months, and that is €900 investment income. Now, as I said, investment income should go into its own account, and it would go on the credit side because it is a revenue, right? But if the bookkeeper eat it, right, put it into the patent account, for us to fix that then, right, we have to keep the trial balance equal here. And if I put 900 on the credit side, I'm going to have to put 900 on the debit side as well. For me to take that out of the patent account, I have to add it. All right. So that is a huge mistake by the bookkeeper. So by me putting it into, imagine your patent account here. I'll just draw this out here. Imagine your patent accounts. Your patent account is your asset account. And so if I had my patent in here, right? So I have my patent in here, but then the bookkeeper Egypt put 900 on this side, like credited 900 because it is a revenue item, you know, that would reduce the amount of the patent. So that is why we're taking it out here. And to take it out here, we just, you know, put it on the other side to equal it out. And that's why we are plusing that. So that is the patent adjustment. So look, it's going to look like this. Patents written off is going to be an administration expense. You're going to have 40,600 plus €900 and then divide that by 5 years because that is what we have left. Okay, you're not using the 7 years because it's already been done for 2 years. So it's €8,300 there is the patent written off. Up in the balance sheet, you're going to have your patents plus your 900 minus your 83. So you're taking away the patent written off there, the 8300, and you are left with patents of €33,200. Now, you got your investment income, so you have to show that somewhere, okay? So the bookkeeper they did record investment income, but they put it into the wrong account, right? But you have to show, okay, look, we received 900. That's going to reduce my investment income due by €900 there. Okay, so that is the crack with that. That's that adjustment done. Okay, adjustment number 5. The suspense figure arises as a result of an incorrect figure for debenture interest, although the correct figure had been entered in the bank account. And discount allowed 400 entered only in the discount account. Okay, so suspense account is created because we all make mistakes, right? The trial balance did not equal. Okay, so I'll just show you this trial balance here. This trial balance has to equal, okay? They included a suspense account. So suspense account is where all the mistakes are just shoved, right? So they included a suspense account. They fired it in with the salaries and general expenses. They fired a figure into this so that my two sides would equal again. Okay, so what we have to do, we have to fix the mistakes, and then this suspense account will basically be gone, right? We'll fix it. Okay, so let's take another read here. Suspense account arises as a result of incorrect figure for debenture interest, although the correct figure had been put into the bank account. Okay, so incorrect figure for debenture interest. So here's my debenture interest up here. Debenture interest for the first 9 months, 5,400. Now, that should be, if I look down here at my debentures, I've got 140,000 debentures, 8% debentures, including 40,000 issued on the 1st of the 10th. So for the first 9 months, it should be 100,000, because that's what it was for the first 9 months, multiplied by 8%, multiplied by 9 over 12. And that is €6,000. Okay, so how would I make this 5,400, 6,000? Well, what I would do is I would add €600 there. If I add €600 to the debit side, I'm going to mess up my sides, right? My two sides are not going to equal then. I'm going to be 600 up on the debit side and my credit side is going to be down. So remember, your debit and credits always have to equal. Now, for me to get my two sides to equal again, what I'm going to do is I am going to minus 600 from the salaries and general expenses on the debit side, 218,355. Okay, so that is that's the first mistake fixed. Okay, second mistake, discount allowed 400 entered only in the discount account. Right, so who do we give a discount to? Discount allowed. We give a discount to the people that we sell to on credit. We give a discount to debtors. Debtors are deadly because they owe us money. Debtors are deadly. Creditors make us cry because we owe creditors money. Okay, so debtors. We need to give debtors a discount. So my asset debtor is going to reduce by €400 on the debit side. And again now, my two sides do not equal. So therefore, I need to do something to my item incorporating suspense to get the two sides to equal again. What I'm going to do, I'm going to plus €400 there. Then my two sides will equal again. So I take my workings from my trial balance, okay, and I just slot them into my accounts. So instead of me having 5,400 debenture interest already paid, I'm just going to cross that out and minus 6,000 instead. Okay, or you could put a bracket around the around the 54 and add the 600, whatever you need to do, but you just need to take 6,000 away. Okay, so that's the first part done. Next part, we're taking €400 away from our debtors. Next part, we are going to take our salaries and general expenses and we're going to minus 600 and plus 400. Now, that means that your suspense account is completely gone. So the suspense account is where you fired all your mistakes until you figured out what they were. Now you've fixed them, so you no longer have a suspense account. Okay, note number 6. A new warehouse was purchased during the year for 100,000 plus VAT at 13.5%. The total amount paid to the vendor was entered in the land and buildings account. No entry was made in the VAT account. Okay, so you're not going to escape leaving Cert accounting without understanding VAT. Okay, so you need to know how VAT works. So the way it works is VAT is entered on the same side as the item it's attached to. So in this case, they were buying a building, 100,000, and then VAT 13.5%. So they were buying a building, which is an asset. So an asset building there, okay, asset increases on the debit, and so the VAT increases on the debit. We're putting 13.5 into the debit. Now, what the bookkeeper did by mistake is they put the whole amount, so the amount paid to the vendor. So the vendor is like Sherry Fitz or, any of these estate agents or the person just selling the land, right? So the amount that was paid to them, the 113,500, was entered into the land and buildings account, no entry into the VAT account. So how do we fix this? Well, we're going to take 13.5 out of the buildings, okay, and then we're going to put it on the debit side of the VAT account. So we're actually going to enter it. So we need 13.5 in the debit side. We didn't have anything, so now we're putting 13.5 in the debit side. What we needed in the buildings was 100,000 on the debit side. What we had was 113,500. So we need to put 13,500 on the credit side of the buildings account. Okay, so that is what we do there. Right, how's it going to look in the accounts? So we're going to minus the 13,500 from buildings, and the VAT we're going to debit 13.5. So in the trial balance, it was on the credit side, which is the liability, which is why we put that here. Now it was 1,900. Okay, so in the trial balance it was 1,900, which is a hell of a lot less than our 13.5, So that means that our VAT is actually going to change into being an asset. So it's going to be an asset. So you've got your 1,900 from the credit side, but now you can minus 13.5. Right, so you're going to have a positive figure here now, and that is going to be an asset. So VAT on the debit side is an asset. Okay, number 7. Buildings are to be depreciated at the rate of 2% of cost per annum, and it says land at cost was 200,000. Okay, the company revalued land and buildings at 700,000 on the 31st of the 12th, 2023, and this has yet to be reflected in the accounts. All right, so why are they telling me about land at cost? So land is not depreciated, so we always have to take the land amount out of the buildings figure. Now, we won't think about this revaluation just yet. We'll just focus on the first part. Remember in the last adjustment that we took 13,500 away from the buildings amount. So we have to be very careful that we don't include the 13.5. So we're going to take the 13.5 away from the 580,000. So remember we had 580,000 in the trial balance. We took away our 13.5 VAT, and we also have to take away our 200,000 land. Then, and only then, we can multiply by 2%, because we do not depreciate land, and we do not depreciate any amount that is not actually our buildings. So that 13.5 is gone too. So that works out at 7,330 now, which we can add up here. Now, the second part of that adjustment says that the company revalued land and buildings at 700,000 on the 31st of the 12th, 2023, and this is yet to be reflected in the accounts. So look, happy days here. We have land and buildings worth 580, but minus the 13,500. Okay, so 566,500. That's what is in our books. 566,500. That's what we think our land and buildings are worth. But then we got a surveyor in, and they said, you know what, we actually think your buildings are worth 700,000 at the end of the year. So at the end of the year, we're going to have cost 700,000, no depreciation, and then we're going to have 700,000 net book value. Now, that's great, okay, but it's not a profit or anything. We are just sitting on an asset that has value, okay? We have not yet, we haven't sold a building, but we are sitting on something that has value. We have to show that in our accounts, okay? So who owns this increase in value? It's the shareholders that own this, right? The business owes this back to them, all right? So it's a long-term liability, and it's called revaluation reserve, and we are just showing that something has grown in value and we owe that back to the shareholders. We have to show it in our balance sheet. We have to show that this is increasing value, and look, this belongs to the shareholders ultimately. So look, revalued at the end of the year, you're going to have three different figures. You're going to have, the first figure is going to be the difference between the 700,000 and the 566,500, which is what our buildings, land and buildings, cost. The second figure and the third figure, so the second figure is the figure from the trial balance, the 38,000 accumulated depreciation, and the third figure is the depreciation charge for the current year. Okay, so that is the revaluation reserve. So there's a lot of different adjustments for buildings. It can be quite tough, but that is what a revaluation reserve is. The increase in value has to be shown in the balance sheet under the finance by in the revaluation reserve, because ultimately the shareholders own that increase in value. Okay, note 8. The rent received was in respect of a warehouse rented out by the company for 1,500 per month commencing on the 1st of the 6th, 2023. Okay, so looking at the rent received, this might be why they give you the word received. This is why they might have been a bit nice, because they were like, look, we're putting in a tricky adjustment here that we haven't really done before. So 13,500 was the amount of the rent received, right? And it's saying that it was 1,500 a month, okay? So 13,500 divided by 1,500, that's 9 months, right? They're telling us it commenced on the 1st of the 6th, which is June, July, August, September, October, November, December, which is 7 months of the current year, okay, which will go into the TPL. And then, okay, we're going to have 2 months, January and February of next year. That'll be rent receivable prepaid, which is a current liability, okay? Now, how is it a current liability, do you say, when like it's money that's coming into you that you've already received? Well, you owe them the use of that warehouse for those 2 months. So therefore it is a current liability. So all you're doing is in the TPL, you're showing, listen, we only have 10,500 of that rent relates to the current year. The TPL, this TPL here, just is basically for this year. If it's not for this year, we get it the hell out of the account, out of the TPL. Only stuff that relates to the current year goes into the TPL. Then you're going to have your rent receivable due for the 2 months over in the balance sheet under creditors minus 1 year, because you owe them the space in that warehouse. Okay, last adjustment number 9. The directors recommend that, number 1, provision should be made for both investment income due and debenture interest due. So luckily for you, you have it done practically, okay? So you had 2400 minus 900, 1500 euro for investment income due. And then debenture interest due, you had your 8800 minus the 6000. So that's 2800. Next, provision for bad debts to be adjusted to 4% of debtors. Okay, so let's remind ourselves, provision for bad debts is, we are just saying in our balance sheet, right, the figure for debtors that I have here, the 69,200, let's just imagine we're not going to receive all of that because things happen to debtors. They might be able to pay us, and this happens a lot in business. So we have to show in our balance sheet like the true status of where we are at with our assets. And if we don't have a bad debts provision when we know last year there was a few debtors that didn't pay us, we're not given a true and fair view of our company's accounts, right? So we have to show a provision for bad debts account. Now, it's not saying that these people have gone bad and they haven't paid us. It's just we are anticipating that they might not, okay? So we've a new debtors figure, 69.2, and we're going to multiply that by 4%, and that is 2768. Then we'll compare that to our bad debts provision that we already have of 3,200, and we say to ourselves, well, this is great because that's less than what it previously was. So I'm delighted about that. The company would be delighted about that. That is a decrease in bad debts provision, which we will put down into the add operating income, which again, I'll remind you, is where we put everything else, every other revenue bar sales here, okay? So operating income, they relate to the operations of our business, okay? So we have the 3.2 that we already had minus what it is now. So 432, we're delighted with that reduction in bad debts provision. Decrease in bad debts provision, reduction in bad debts provision, any of those words are absolutely fine. So that is that adjustment done. Last one, a transfer of 20,000 should be made from profit to the capital reserve. So all we're doing here is, in our layout, we have to be very careful to, as I said earlier on, we have to be very careful to put everything in this correct order. But we're taking 20,000 of the profits here and we're putting it into just a different fund, a capital reserve, which is kept over here in our finance buy. So capital reserve, we already had 15,000 in our trial balance, but we're now just adding the 20,000 that we were told to add. So look, that's a very easy adjustment, but you just have to know the layout in order to get that right. So our last step, we finished all our adjustments. Our last step is to just tot up the totals. Some students take a long time in doing this. They can spend 15, 20, 25 minutes trying to balance. You are wasting your time by doing that, okay? You have to make sure that you're moving on to the other questions as quickly as you can. What you want to do is just tot up all of your brackets and bring them over into the accounts, right? Some years this profit and loss balance figure will be worth a lot of marks, other years it won't. My advice to you would be, if you're short in time, that you just tot up these here, okay? You bring all the totals, you know, out into their columns, like you're totting them all up. All right, that would be my advice. You definitely have to add these here up, okay, because you're penalized sometimes if you don't. But 5 minutes will be the max that I would say to do this. If you do not balance your total net assets and your capital employed, do not worry about it. Go way off and do another question, and then come back if you are if you're done. But if you continue to do steps 1, 2 and 3 and check them as you go along, and then do your adjustments but check them as you go along, you know, you you will have very little mistakes, made, if you have any made at all, but you just do not spend any more than 5 minutes totting this up. So that is the completed one there. Okay, you can pause the video and fill in your figures, or you can calculate them all up yourself. Okay, but that is the 2024 company final account Yeats Ltd completed.